Hey everyone, welcome back to Corporate Decoder, the place where we attempt to make sense of corporate filings and whether or not these companies are actually doing well. This Pineapple Financial Inc. 10Q is certainly an interesting read, specifically when we consider their recent delisting saga and their current stock exchange situation. Before we get into the nitty-gritty, if you're someone who likes to understand what companies are really up to behind the scenes, smash that subscribe button. Also, if you want to connect with other finance enthusiasts and talk about all things corporate, check out our Discord community, linked in the description below. It's a great place to hang out. Alright, so Pineapple Financial Inc. has dropped their quarterly report for the period ending May 31st, 2025. For those of you who don't know, Pineapple Financial is a fintech company focused on the Canadian mortgage industry. They're basically trying to use technology to make the mortgage process smoother for everyone involved. Now let's dive into the numbers because that's where the real story is. Looking at their balance sheet as of May 31st, 2025 compared to August 31st, 2024, we see some interesting shifts. Their cash position has more than doubled, going from $580,000 to over $1.1 million. That's a good sign for everyday operations. But what's really jumped out at me is their warrant liability, which surged from around $41,000 to over $363,000. This indicates a significant increase in the value or number of warrants outstanding, which can impact future share dilution and financial outcomes. Think of it like this: if these warrants are exercised, they'll issue more shares, potentially making each existing share worth a little less. Now, let's see how they performed in terms of making money and spending it. For the 9 months ended May 31st, 2025, they reported a net loss of over $1.8 million. Now that might sound bad, but it's actually an improvement from the nearly $2.4 million loss they had in the same period last year. So they're losing less money, which is a step in the right direction. Interestingly, on the bottom of this income statement, they have a loss per share calculation for the 9 months ended May 31st, 2025, which comes out to almost $350 per share after a significant 20-for-1 reverse stock split. This means before that split, each share had a tiny value, which is a common strategy to try and boost a stock price and meet exchange listing requirements. This statement shows how the owner's stake in the company has changed. We can see here that their common shares have gone from about $8.5 million at the end of August 2024 to over $9.9 million by May 2025. That increase largely comes from issuing more shares, which is how they raised capital, but it also means more shares are out there diluting ownership for existing shareholders. Let's look at cash flow, which is crucial for any business. For the 9 months ended May 31st, 2025, they used over $400,000 in operating activities. Again, this is a significant improvement from the nearly $1.5 million they used in the same period last year. They are getting better at managing their day-to-day cash, but they are still burning cash. Delving deeper into the cash flow statement, we see that the change in fair value of warrant liability was a significant positive for cash from operations this time around at over $341,000. This is a non-cash item, meaning it's an accounting adjustment, not actual cash coming in, but it definitely helped reduce the cash used in operations. On the financing side, they brought in about $1.8 million. Looking at the prior year, they brought in over $2.4 million. So they raised less cash through financing this period. This is partly because they got proceeds from a loan, but also they issued more common shares. The company is definitely using equity to fund its operations, which is common, but it's something investors always watch closely because of that dilution we mentioned earlier. Now, into the notes where the real details are often hidden. They mention that they received a delisting notice from the NYC American and are appealing it. This is a big deal because being delisted can make it much harder for people to trade the company's stock and can hurt its reputation. They're hoping a reverse stock split will help them meet the listing requirements. Here in Note 1, under Going Concern, they highlight their accumulated deficit, which is essentially their total historical losses. It's at over $11 million. They're also still posting operating losses and negative cash flow from operations. They've raised money through share issuance and director loans, but they acknowledge that their ability to continue as a going concern is subject to their capacity to achieve future profitability and secure necessary funding. Basically, they're saying they might not be able to keep the lights on without more money. Note 8 discusses their warrants and how they are accounted for. They explain that some warrants don't meet criteria to be classified as equity and are instead considered financial liabilities. The value here has ballooned from $41,000 to over $363,000. This increase is impacting their financial statements through gains and losses on fair value changes. It's a complex area, but essentially the market's perception of these warrants' value has significantly changed. They have property and equipment that's depreciating, which is normal. The net value is only about $84,000 as of May 2025. This tells us they don't have a lot of physical assets like factories or heavy machinery. Their business seems to be more about technology and people. Now, this is interesting. Their intangible assets, which are mainly software development costs and other intellectual property, have grown significantly. They are now over $2.5 million. This is where they are investing heavily. They even mention revising the useful life of some software from 5 to 7 years, which is a judgment call they're making about how long that software will be valuable to them. Note 7 on share capital really highlights their fundraising activities. They've issued millions of shares in the last year through IPO follow-on offerings and for other agreements. As of May 2025, they have over 20 million shares outstanding, which is a massive increase from just over 8 million shares about a year prior. More shares mean more dilution for existing shareholders, but it also means they've raised a lot of capital to hopefully grow the business. Let's look at management's own take on things. They mentioned that despite economic headwinds like high interest rates, they originated over $1.8 billion last year. So they are doing more business. Their net loss improved by over $500,000. The key performance indicators show mortgage volume increase nicely. Gross billings are up, commissions are up, and revenue is also up. This all sounds pretty good on the surface, but remember that overall profit picture we saw earlier with the net loss. This table really breaks down the financial movement. Revenue is up by about 11.78%. That sounds positive. However, their salaries, wages, and benefits dropped by a massive 30%. That's a big cost-cutting measure. Interest expense, though, has skyrocketed by nearly 450%, which is probably due to the new loans they've taken on. Underselling general and administrative expenses, we see a significant increase in dues and subscriptions, which jumped by nearly 150%. They attribute this to expanding engagement with industry groups and data services. On the flip side, software subscription costs are down because they discontinued Salesforce. Advertising and marketing expenses are down slightly, which is a good sign of them being focused on efficiency. The big story here is salaries, wages, and benefits, which are down nearly 33%. This is a direct result of workforce optimization initiatives, likely meaning some layoffs or restructuring. Let's talk about cash and liquidity. As of May 31st, 2025, they have over $1.1 million in cash, which they say is an increase from last year. This is good, but when you consider their ongoing losses and the amount of money they are likely to need to keep operations going, it's hard to say if it's enough long term. Their total current liquid assets are nearly $1.4 million, up from about $890,000 last year. This improvement is thanks to new equity and financing activities. As a smaller reporting company, they don't have to provide much detail here. They basically state they aren't subject to significant interest rate risk because they don't have variable rate loans, but they do mention credit risk on receivables and cash. This is where they talk about the big risks. Trading on the OTC pink market is less liquid and more volatile. That means it's harder to buy and sell shares and the price can swing wildly. They're really hoping that reverse stock split will help them get back on a major exchange like the NYSE American. They also warn the split might not work and could even make things worse for liquidity. This section confirms the 1-for-20 reverse stock split plan for June 26. They are clearly trying to get their stock price up to meet exchange rules. So what's my take on all of this? Pineapple Financial is in a tough spot, but they are clearly fighting to survive and grow. They're cutting costs quite aggressively and they're raising capital, which indicates a belief in future growth. However, the persistent operating losses, the reliance on external funding, and the ongoing struggle to maintain exchange listings are significant risks. Their investment in intangible assets like software shows a commitment to their tech strategy, which could pay off, but it's a long road ahead. They're trying to make a comeback, but it's still very early days, and they face many hurdles. Alright, that's our breakdown of Pineapple Financial Inc.'s latest report. What do you think? Are they on the right track, or is this just a company trying to keep its head above water? Let me know your thoughts in the comments below. If you found this analysis helpful, please give this video a thumbs up and subscribe for more. And one last reminder, join our Discord community linked in the description to keep the conversation going. Thanks for watching, and we'll see you in the next one.